This is Optimal Finance Daily. Why investing in things producing things produces financial freedom by Chris Reining of chrisreining.com. And I'm your host and personal finance enthusiast, Diana Merriam. This podcast is actually one of multiple shows in our network covering different topics like personal development, health, and relationships. So if you like narration-style podcasts, be sure to search for Optimal Living Daily wherever you're hearing this and check out our other shows. But for now, let's get right to today's post as we optimize your life. Why investing in things producing things produces financial freedom by Chris Reining of chrisreining.com. Years ago, a coworker casually mentioned to me the only reason she showed up for work was that all her friends were there. I asked, "So what happens when you retire?" It caused some nervous laughter, and then we went about our day. Just a few weeks later, the company let her go. Don't think after putting in 20 plus years, you're not disposable. She emailed me a month later asking if I knew of any positions in our field. You could sense she was desperate for money. This causes you to pause and think, what kind of life is this? Taking orders from people, dealing with office politics, worrying about getting laid off or fired, and then begging someone to please hire you one more time. Plus, there's mountains of evidence that many workers find their jobs completely meaningless and unfulfilling. At some point, you might realize there's no amount of money that changes the fact that you're wasting your time. Could the answer be as simple as what Benjamin Franklin once said? Quote, "Remember that money is of a prolific generating nature. Money can beget money, and its offspring can beget more." End quote. Instead of endlessly working for money, you can have your money work for you. Well, that's what investing is. While it can mean many different things, what it always means is owning assets, things producing things. A rental house isn't a pile of bricks with a roof. It's a monthly check. A share of a stock isn't a lottery ticket. It's part ownership of a company. What doesn't produce things? Think cryptocurrency or gold. You're just hoping someone else pays a higher price, and that person hopes the same thing. The key difference is speculating about price is likely to ruin you, while investing in things producing things like real estate and stock is a well-worn path to financial freedom. Things producing things, real estate. Investors buy apartment buildings or farms or single-family homes for the cash flow. If you're not buying the asset outright, most of that cash pays for the mortgage, property taxes, maintenance, and repairs. But eventually, it generates steady monthly income. In 2012, after the U.S. housing bubble and Great Recession, 30-year mortgage rates were hovering around 3%. It was a fantastic time to buy real estate at distressed prices, financing it at very low rates. A leveraged way of owning a cheap, productive asset. As long as there are tenants, the money shows up in your bank account each month like clockwork. Which reminds me of a story about a guy who owns a 70-unit trailer park and 200-unit storage facility. When times are bad, people are looking for cheaper places to live and store their stuff. And when times are good, well, there's always someone that's not doing so good. In other words, real estate can work as a hedge against downturns, while at the same time a hedge against inflation because rent prices rise over time. Things producing things, stocks. The reason investors want to own stock is because over long periods of time, it appreciates more than real estate. For instance, using Robert Shiller's data, over the past 30 years, real estate returned about 1%, while the S&P 500 returned 6%. What that means is if you're going to buy an asset compounding for 30 years at 1% versus 6%, the difference there is 5%. And what 5% does to the results over long periods of time, like 30 years, is pretty eye-opening. Here's the math. A $100,000 piece of real estate compounding at 1% will be worth $135,000 in 30 years, while a similar stock investment at 6% will be worth $575,000. That's a difference of $440,000, and why people want to own stock. Of course, on average, the market falls 10% once a year, about 20% every 4 or 5 years, about 30% every decade, and 50% a few times during a lifetime. Market volatility makes holding stock more difficult than real estate, but it's the price investors pay for superior long-term returns. Things producing things produces financial freedom. Real estate provides steady inflation-adjusted income, and there aren't minute-to-minute market valuations which cause investors to panic and sell. Stocks, being sensitive to every minuscule macroeconomic event, have short-term volatility but provide long-term reward. Warren Buffett quipped, quote, "If you don't find a way to make money while you sleep, you will work," end quote. The point is that it doesn't matter how you have your money working for you, because $1 from a rent check is the same as $1 from a stock. What matters is investing in things producing things. You just listened to the post titled, "Why Investing in Things Producing Things Produces Financial Freedom" by Chris Reining of chrisreining.com. And I'll be right back with my commentary. Buy low, sell high. Buy low, sell high. It's a simple concept, but not necessarily an easy concept. Right now, high interest rates have crushed the real estate market. Prices are falling and properties are available at a discount, which means F.I.R.E believes now is the time to expand the F.I.R.E flagship fund's billion-dollar real estate portfolio. You can add the F.I.R.E flagship fund to your portfolio in minutes by visiting fundrise.com/OFD. That's FUNDRISE.com/OFD. Carefully consider the investment objectives, risks, charges, and expenses of the F.I.R.E flagship fund before investing. This and other information can be found in the fund's prospectus at fundrise.com/OFD. This is a paid advertisement. As I was reading this, I could hear thousands of you thinking, 1% long-term appreciation on real estate? That can't be right. My home has doubled in value since I bought it. So let's dig into this a little more. Well, I'm personally not a real estate investor. I had the pleasure of recently seeing Rich Carey from Rich on Money speak at Camp FI about this very topic. Rich owns 30 rental units, and I was really surprised at what he had to say about appreciation. He was making the point that real estate investors need to focus on cash flow and only buy properties that fit the 1% rule, which basically states that the property's monthly rent must be equal to or no less than 1% of the purchase price. Many people who invest in high cost of living areas where properties that follow the 1% rule are nearly impossible to find will often say that they're banking on appreciation of the property over the long run. The trouble is that over the long run, appreciation on real estate typically just keeps up with inflation. But you may have periods where you see big jumps. So for example, Rich bought a house in 2003 for $280,000. And 2 years later, the house was worth $400,000. That's a 42% increase in value, which is awesome. And this is what you hear all the time when people talk about their homes appreciating. However, when he sold that house in 2016, it sold for $400,000, meaning that it didn't appreciate any further over 13 years. And the real appreciation was 2.6% per year for the time that he owned it. To put that in perspective, over that same period, money invested in the S&P 500 index would have returned 118%. This is another reason why many people in the personal finance space will point out that your primary residence is not an investment. A property is an investment when it's an income-producing asset, and it becomes an income-producing asset when you focus on cash flow on rental properties, not appreciation. And that's a wrap for another Monday show. Have a great rest of your day and start to your week. And I'll be back tomorrow where your optimal life awaits.